Good morning, everyone. Thank you for joining us. Seth Glasser, joined by Andrew Bronsteen, Joe Koicim, Mike Salvatico, and Jake Kahn from MMCC. He handles a lot of the financing in our office. So thank you guys for joining us. We're looking forward to having a really productive, informative, and fun, lighthearted conversation with you guys. So thank you all for joining. So quick agenda and some housekeeping items. We're going to try to keep this to certainly under an hour, maybe 45 minutes or so. When we thought about putting this presentation together for the market and thinking about, well, how do people process information and what are they looking for? We kind of broke the market down into 5 different kind of quadrants. Hybrid buildings where it's like part stabilized, part free market. That could be 20% free market, or it could be 80% free market. 100% free market, often most commonly seen on the transaction side as buildings that are 5 units and under. 100% rent stabilized, development, and then financing. So that could be refinancing or financing new acquisitions. Before we get into some of the nuances and deal specific items, we always kind of keep track of this every quarter. Our opinions of value presented, new listings and transactions put under contract. And you can see Q1 in 2026 was all across the board, up and to the right. And so as brokers, we're really happy to see that level of activity. It means that there's an overlap between buyer and seller expectations, rental increases, momentum, and that sign is all positive here. So last year we sold 84 apartment buildings, about $500 million only in New York City. So that was a really nice year. Now let's get into it. Joey, I'm going to start with you. I want to congratulate you, first of all, on this deal on Thompson Street downtown, sold for $58 million. Why don't you give the audience a little kind of background? Why did the seller sell it? Why did the buyer buy it?
Sure. So this was a sale that was done off market. It was 80%, 85% free market. Owner owned it for about 15 years. Wasn't a big apartment building owner. Decided to take his chips off the table and exchange into what he knows outside New York, industrial. We had the right buyer at the right time and in exchange with the last day to ID. And this sold, which is not market today, at a cap rate of sub 5%. It was like a 4.7 cap at $1,600 a foot. The reason I'm bringing this up is there's just a lot of 1031 money for the right product that'll sell today. And it was just right place, right time with the exchange buyer. And, trophy type assets like this will still sell at a premium.
Yeah,
even in today's.
Congratulations. When the buyer was kind of looking at, he bought the building from a professional operator who certainly knew what they were doing and has a very nice reputation in the market. It's not, I think the average person would say that the person who sold it knew what they were doing and was able to capitalize on the rental momentum. What does the buyer of this building, what is his thought or her thought on where rents are going in this submarket? Because to pay a sub 5%, you would think significant rental.
The one key fundamental right now in apartments, especially downtown, is the rental market is on fire, right? So rents continue to rise. Where these rents are at $100 a foot, they think they could command even a higher price for these rents, closer to $120 to $140 a foot we're seeing in some similar type buildings. So there's upside. There's a little bit of value add. Obviously, 85% free market. The diligence was, very diligent, and, you have to have the correct paperwork in order to sell these buildings. And that's a key part where we're getting involved to help navigate around those regulations in terms of having the correct paperwork and having the right attorney to help navigate that process.
Okay. So how do you coach sellers or potential sellers that are thinking of selling? Let's say I owned a building like this and I wanted to sell it at some point this year. And I said, Joey, what do I need to know? And how do I set myself up for success? What would you say to me?
So I think it's important for sellers to do an internal audit of their leases to see what they have files wise in terms of proving the deregulation. So the diligence being done up front, so there's no surprises down the road. And really, cleaning up the building so it has the first right impression to buyers, I think is important, especially for a product like this. We're seeing a lot of turnkey product going to foreign capital, which we'll speak about in a few slides. And that's really important in terms of how you set the building up for success and how do you position it to the right buyers. This is a totally different type of opportunity, right? Where this is a corner asset on the Upper East Side, half stabilized with 20,000 square feet of air. So it's a future assemblage. But the cap rate's a lot higher because of that, because of the inability to grow the rents on the stabilized, right? Which I know a lot of people on this call are having that same question in their head. And, what do you do? How do you buy these buildings if there's no upside? But there are buyers that are taking a longer term bet for these type of opportunities. So this is going to trade.
That there's, you mentioned that, sorry to cut you off. You mentioned that there's air rights on the building. It looks like there's a big building next to this. How do you quantify air rights in a building like this? It's half stabilized, like there is air, so it's worth something, but like you can't use it today. How do buyers kind of report back to you on, that type of feedback?
I think it all depends.
Well, there's air rights.
Yeah. It all depends on the situation. If the neighbors can use it, can you sell it down the road? In this case, this is a corner, so it's attractive. If something does change in the rent laws, which that I know you think something will change, right?
I know something's going to change.
Okay,
something is definitely going to change. It's just a matter of when and what it looks like. But
correct.
That is
So most buyers won't put value is solely on the air, but it has some perceived value in the future.
Okay, nice. All right, let's keep breezing through this. This on St. Mark's and 2nd Avenue. Nice location down here. What's the story?
Yeah, another great corner asset. The owner did a great job repositioning the asset. It's like it says, almost 80% market. A lot of retail on that corner. We're selling the corner across the street as well. There's just a lot of action for this type of scale in New York. So it's hard to get the scale. So this is good. We're asking a 6 cap. This is going to trade in the low 6s, right around $1,000 a foot. And, seller is just looking to move into another asset class. And that's the reason he's selling today.
So the people that are buying these types of hybrid buildings, a lot of times they'll ask, well, what percentage free market? And at what point do the buyers say, you know what, there's too much stabilized? Is it 30% stabilized, 50% stabilized, 70%?
I would say the threshold is 30%. It depends on the buyer you're talking to. But a lot of the foreign capital that we're speaking to, like the Japanese investors that are coming in, their threshold is right to cut off at 30%. Mm-hmm. Obviously, proving the free market units is important and getting through the paperwork. But I would say that's the kind of level of interest. And there's a big swing in terms of cap rate if you could prove that the building's completely deregulated, statutorily deregulated, and it's fully free market, which we'll get to in terms of cap rate shortly.
Okay, nice job. 247 Broome Street.
And this is on the market. This is going to trade at a 7 cap. Mainly
7?
7 in downtown, right? So we're selling 3 other assets. We sold 3 other assets for this client. And, Lower East Side is strong. The rents continue to go up. There is, there's upside in some of the free market rents, but a lot of, because it's 60% stabilized, it hinders obviously the cap rate. So,
okay, so what you're saying is this 60% stabilized is a 7 cap. This
I'm not saying 60% is a 7 cap. We're asking a 6.5. The offers are coming in between closer to a 7. It's going to trade close to a 6.5, just to be clear. But
I know. Disclaimer.
What I'm saying is there's less buyers for heavier stabilized buildings.
Got it. All right. And then just breeze through these two, East Broadway, 19th Street.
Yeah, no problem. So have stabilized on East Broadway. Just go back to that for a second, Seth. This is in, Dime Square, good location in the lower East Side. And this traded to a buyer out of California who just really loves the neighborhood and is making a bet on the neighborhood and a bet that the laws will change. This is the cleanest stabilized building I've ever seen. So
when you say lower East Side, you mean Chinatown?
No, not quite. Let's go to the next one because this one in Chelsea commanded a lot of attention from foreign capital because it's almost 80% market, elevator building right next to the High Line. And we're able to execute this transaction, 30-day close, all cash with a buyer from a Japanese group. And a lot of these buyers from Japan are taking advantage of the tax benefits in Japan that they are able to get from accelerated depreciation on these type of assets.
Wow, that's really amazing.
So we're working with not just one, but multiple groups that are aggressively buying these type of assets. So if there's anybody on the call that's interested in and has 80% market rate buildings or close to it, we should be speaking.
How, there's been a lot of talk, and we're going to talk more about this with the rest of the panelists about foreign capital and kind of like unicorn buyers, right? Everyone wants to, all the sellers want to find an out of the box type of person. Joe, when you're talking about these Japanese buyers that have been hitting top of market, on average, what's like the typical step down from like the buyer at the top who wins the deal to the next highest bid? What is that type of premium? And I know it's a hard question to answer and it depends on the deal, et cetera, but I don't know if you can kind of simplify that.
We're going to answer it two ways. Simply, it's 3 to 5%, maybe 10 in certain scenarios. And then there's just a big drop off from the actual, buyer pool where most of the market buyers are and where the unicorn, like you suggested, Seth, are. So it really depends on the asset. And, some we're not getting, certain locations we're not getting as much attention as we are in these West Village, Chelsea locations.
Yeah. And sometimes I'll put it out there for the audience, like, we don't know. You know what I mean? Right? Like, you don't know what some of these groups might pay. And the only way to find out is put it on the market and put yourself in a position to get lucky. So nice job on that closing. Let's move to the 100% free market buildings. Joe, is this one you want to hit?
Yeah, this is just about to hit
Street.
the market. This is just about to hit the market. This is 100% free market, no tax abatement in the Lower East Side, 37 apartments. The owner owns mostly office buildings. Bought this in an exchange in 2018 when it was built. So no, like I said, no tax abatement, fully free market, no issues, no questions on paperwork. No attorney can bring up anything here because when it was built, and this is going to command a much more aggressive cap rate. This is going to trade in the low fives.
And how are rents here relative to market? What do you?
The rents are market. Maybe there's a way to push it if you want to kind of chop up the units further. This current owner, like I said, is not a multifamily operator and is looking for just to get out of the asset to move on. And there is upside, maybe there's place to put some extra amenities. But for the most part, it's a, core plus deal.
Nice. Rare find to find a big building. Not, a lot of times we find these bigger buildings that are free market, but they're not free market yet because you got 5 years left on the 421A and then you got to turn the unit. So that's an interesting opportunity. All right, Andrew Bronsteen, let's get to some of these smaller buildings that you guys have been just ripping through the market. I mean, this is the highest velocity product type in the market when we look at the trades, kind of brownstone, townhouse, Brooklyn. So kind of maybe just high level, what's happening in the market? Tell us very briefly about this building.
Yeah, sure. I mean, high level, you talk about where the unicorn buyers live. This is where they live. We're hitting some crazy pricing on this type of asset, the fully free market, statutorily free market. Really, I mean, high level, the reason for that is really two main landmarks, which I'll breeze through pretty quickly. One, everyone knows 2019 saw the entire investment game in New York City change. A lot of people went from buying rent stabilized to not buying rent stabilized, and that's kind of progressed over the last, crazy to say, but 7 years now. And the second big thing that we've seen in the free market space is there's been really a splintering of interest since good cause eviction came about in 2024. So what we're seeing here in general, what you'll see on the next few slides is that there's the two hottest free market property types are occupied, turnkey, cash flowing, good locations, prime product. And then the second is vacant value add. So like this deal, 626 Vanderbilt, this is a 2/1, 2 apartments, 1 store, fully occupied. Real simply, the selling point here was location. There's not many deals that come available on Vanderbilt, fully free market, not quite hitting Joey 4 caps over here, but we are hitting Bronny sub 6 caps. Sub 6. Yeah, just sub 6. My partner, Jason Freese, did a great job on this. We worked.
So who's the buyer? Like, why is somebody buying two apartments and a store for a sub 6 cap for almost $3 million? They can go to the Bronx and buy like 50 apartments. Like, why buy two over one?
Exactly. Because then they have to deal with 50 stabilized tenants as opposed to 2 and 1 retail that's going to be there for a while. So yeah, the buyer on this is a 1031 buyer. We saw a huge amount of 1031 buyers to start the year off. And this is just safe, good location, cash flowing. It's a 5.9 cap at the sales price.
Tax
And
loss protected too, Bron. That's a big.
that is a huge
Right.
point. Yeah, taxes on this one are like sub 10,000. So that's a big point.
Yeah, that's ridiculous.
Yeah,
Wow.
just a
Okay,
safe,
nice.
safe, good building.
Okay. And why is this building twice the price?
Well, it is twice the size almost. This is a similar building. This is a very good location on a corner, 3 apartments, 2 stores in Clinton Hill. We are asking 5, and hopefully by the time this webinar is over, we'll be under contract at a very strong number. The person buying this is a unique buyer. This is another unicorn buyer. They live in the area, they run businesses, they own a small amount of real estate. This is going to be something that they own forever and ever, and they're paying $900 a square foot for this. The apartments will be delivered empty, but the building's renovated. And again,
So it seems like the buyer pool for these little Brooklyn buildings is like the stars in the galaxy, like unlimited. That's really what it feels like, kind of from an outsider looking in to your business.
yeah, I mean, there's definitely a huge market for this. The thing is, the buyers on these 2 assets that we just went over, like, they are the unicorns. We'll have, a dozen to 20 offers on this building that are all within a relatively close price range. And then we'll get that 1 or 2 who's just 10% above the rest of the market. And
Okay. So Jake, I want to bring you into this part of the conversation here a little bit, because this is interesting where Andrew will have 10 or 20 bidders on this, and maybe 80% of them he's never spoken to, right? At least initially, yet some of them are able to close. But if I gave you that same scenario for a stabilized building, you would probably tell me it's a lot harder for that person to line up financing to buy a fully stabilized building. Yet the buyers for these buildings that are small, free market, little Brooklyn townhouses have no problem getting financing. So what's your kind of reaction between what I just said there?
Yeah, look, we're living it in real time. We're feeling it as well. I would say, overall, the entire spectrum of lenders is still active in New York, and the debt markets, the financing markets feel really good, but it's totally bifurcated. When you look at, fair market versus, rent stabilized, essentially what we've seen over the last 7 years is on a stabilized asset prior to 2019, you'd have north of 15 lenders lining up to finance a deal. As a result of that, the last few years, it's been 5. And since Mamdani came into office, it's more like 2 or 3, right? So there's really a much smaller lender pool for rent stabilized assets. Now, on the flip side, for a building that Andrew is talking about, market rate, a little to no rent regulation, the lender pool is extremely deep. On any given deal, we're still looking at 10 to 15 plus lenders.
And
So it
what
feels
sort of
good.
debt coverage ratio are they looking for on these free market buildings, these little buildings?
Yeah, we'll see as low as 120. It's generally closer to 130, depending upon what percentage of the retail, relative to the gross income. So it's generally 1.3%.
Which is really interesting to me, because you guys are seeing rents $4, $5, $6, $7, $8,000 a month. Like, they just keep going up, and the debt coverage ratio on these little free market buildings is basically the same on the stabilized buildings if you're able to get the financing. Yet if the bubble bursts on the rental market and those rents come down, like a COVID type event, you're so far underwater from the lender's perspective. So that 130 cover can go to 1.0 really quickly with some type of rental reset. And I'm just thinking out loud.
Yeah,
It's interesting to me.
that's an interesting point. Look, lenders have dealt with, bubbles bursting too many times, unfortunately. What's impossible to underwrite is regulatory risk. Sure, you might have an idea of what it may look like, but I think we can all sit here and say that back in 2018, early 2019, we did expect the rent laws to change, but we didn't expect them to be as extreme as they were.
Yeah. All right, Andrew, I want to come back to you. Joey talked a little bit about some of the diligence issues on the hybrid buildings. If you have 5 units and under, there's no question that it's a free market building. What sort of due diligence issues do you typically run into with a purchaser, if any?
Do we have floor plans or not? These are like
Floor plans, survey,
like,
title. That's pretty much it.
yeah, is title clear? And I guess the one actual thing is, was this ever at any point more than 6 or more units? And it narrows the buyer pool a little bit, but that's the only potential hiccup. And it's usually if the building's, vacant or been occupied for a while, it's fine.
Okay, nice. Thank you. All right, Mike, I want to get you chiming in here a little bit. A lot of these Brooklyn-y townhouses, the way that I've kind of thought about it and it's been articulated to me, you have kind of like a few different uses for one building. It could be single family townhouse, condo conversion, a rental, or maybe some type of redevelopment. If there's a couple 1,000 feet of air rights, you can build like a pop-up on it. What's your observation between where most of these types of buildings are landing? Is it evenly spread out between those two kind of end games? Is it gravitate more one or the other? How do you kind of think about that?
Yeah, I think it's neighborhood to neighborhood. I would say that generally, like the very good neighborhoods, meaning Cowell Gardens, Cobble Hill, Brooklyn Heights, North Williamsburg, it's almost certainly condo conversions. And Cowell Gardens, Brooklyn Heights, it's townhouse conversion. So, but I would think generally, it's probably a mix, right? I would say there's also a lot of end users that are buying these 3 and 4 family buildings, but sometimes these investors are also competing with the end user buyers. So I'll tell you, like we were talking about, there's just a massive buyer pool for 3, 4, 5 unit buildings right now, especially vacant.
Yeah, interesting. Jake, if I was an end user of the building and I wanted to live in it, how does my financing compete with, let's say, Mike, who wants to just buy it as an investment property? Do I get better financing if I'm living in it versus Mike, who's renting it out?
Yeah, depending upon, the size of the building in terms of unit count and the loan amount. If you're going to live in it, you could, you'll likely get a higher loan to value, at a similar interest rate.
Yeah. No, okay. Yeah. So
I'll just add on just the reason why investors are liking these 3, 4, 5 families, because there's a guaranteed exit in some sense, that there's, private equity exit and then also foreign capital. So the Japanese buyers that Yo was working with are buying these 3, 4, and 5s in really good locations. So
okay. Yeah. So what is their exit? How are they kind of thinking about, if they're buying these are like mostly 6 and under cap rates. I mean, these are like really tight spreads. How are they underwriting the exit?
I mean, I think that they are building into, above 6s, generally in terms of the investor pool. And then you can sell these, if they're fully renovated, really nice buildings, mid 5s, maybe low 5s, depending on location. So there's a spread, and there's not just one buyer as an exit. So that's why I think and also again, it's certainty of execution, which we'll talk about in development. That's just where the investors are going to and flocking to.
Yeah, interesting. Okay, before we get to stabilized, I want to wrap this up here, but there's been 1 or 2 like premium buyers in the Brooklyn townhouse market that if you check their boxes, they buy it and everyone knows they pay a big number. How far below that top bid is the next highest buyer? Is it a 10% gap, or is it tighter than that? Like, how do you kind of think about the delta between 1 and 2?
I would say it was probably a big gap where there was 1 or 2 buyers that were just buying up everything. I would say over the past 6 months, and Bronny probably can agree with this, I think that gap is closed. We're now, in that top 5%, there's 4 or 5 buyers. So I think that is what's changed. And I just think more people are flocking to the tax protected, vacant, statutorily free market buildings. That's, so there's, I don't want to say a limited demand because I don't want to over promise, but there's a lot of demand. Let's just say that.
Yeah, I don't want to.
We're going over asking price on deals now, which hadn't happened in a long time. So
that's amazing. Okay, so if I owned one of these little inherently free market buildings and I was thinking about selling it, what would you say to me? Should I wait until after the summer rental season? Should I wait till rates drop? Is this a bubble? Right now, everything that you guys have told me has been the financing is more favorable. There's an unlimited amount of equity. the guy who lives in a rental across the street with 500 grand under his mattress could buy it and qualify to buy it. So the buyer pool is infinite. It seems like the neighborhoods keep getting better. I don't know. If you owned one of these, would you be a seller now, or do you think we're not at the peak?
I mean, I think that I'm always a believer long-term vision, that I think that, these buildings are going to be worth more 5 years down the road. But I will say this is as good as time as I've ever seen in terms of selling these buildings. Because again, like, it's all the laws, the rent laws, that actually helps these pricing. So like, you just have more and more buyers. So the demand, I don't know how much more you could get, is my point. So it's a great time. But again, over the long term, I do think, they'll be worth more. Just I'm a believer, especially the A markets.
Same with the rental market, right, Mike? Right, the rents
Yeah.
are hitting like the peaks. They keep
Yeah.
going higher, but
How
is there
sustainable is
going
that?
to
I don't
be
know.
a ceiling? Is the question, right?
Yeah. But yeah, over the long term though, you're not gonna lose. But if you're selling in the next 2 or 3 years, it's definitely not a bad time. So.
Yeah. All right. Well, okay. Before we get into the stabilized world and then into development and more questions for Jake, I want to remind everyone in the audience, if you have questions, put it in the chat. The panelists will see it and we'll answer a lot of these at the end. So some of these 100% stabilized ones, Joey, this is you, Bowery Street.
Yeah, this is
stabilized.
Chinatown, Seth. This one is Chinatown.
I knew it was in here somewhere.
No, this one isn't Chinatown. So this is on Bowery. We're just about to launch this week. This is a fully stabilized building, but that is renovated. There was a vacated order a couple of years ago. The building had to be completely renovated to make sure it was up and running for the rent stabilized tenants that live there, and an average probably sub $1,000 a month. So you have a brand new stabilized building on one of them, and a brand new restaurant that just opened up that's doing really well. One space is being leased right now, but it's the two buildings, 83, 85 Bowery, and we're asking $330 a square foot at around a 6.5 cap on the asking price.
Wow.
So this will get attention from a basis, right? Every buyer out there wants low basis. The question is, who's willing to buy rent stabilized buildings? And with that question, there's a lot of answers, because we are selling, right, Seth? I mean, how many buildings are you selling uptown right now to rent regulated buyers? So, this will command attention because of location, 50 feet of frontage, and a strong Bowery location.
It's interesting though, like to buy it's a new renovated stabilized building, and the tent, was there a fire in there? There was obviously like a significant problem. The tenants, flagged it. Now they get a new building, $1,000 rents. They're probably never going to leave, right? It's not like the ceiling's collapsing anymore or anything like that. So if I'm going to buy this, what kind of mindset do you think I need?
You're buying away.
And when the rent laws change, like why would any of these tenants leave if they live in a new building?
That I can't answer, but to replace one of the buildings is brand new. The other one is not, but below replacement cost, right? It's $330 a foot. You can't, so
Cheap.
Obviously basis is cheap, and future upside, it does, if something does change, and upside in the retail as well.
Okay, so this is a little different. Salvatico, do you want to? You familiar with this one on Prospect Place?
It's more broad.
I can speak to that.
Andrew, go ahead. What happened here? Like, why did the buyer buy this? Give us a little background.
Yeah, partner Dan Greenblatt did a great job with this one. This is just like a super clean, fully rent stabilized building. The buyer is, I would say, West Coast buyer, but he owns a bunch of this type of asset, and he's just getting in at a basis that you can't really beat. It's over a 6 cap, but the price per square foot, this is like right near the park, Prospect Park. It's a great location in Prospect Heights, and he's buying it for $140, $150 a square foot.
100 something bucks a foot. The buyer on this came from LA, so he's familiar with rent regulation. We've sold him a bunch of stabilized buildings, basically the cleanest buildings in the best locations at the lowest price per square foot at, call it, neutral leverage. He's selling out of stuff in LA at lower cap rates because they have vacancy resets out there. They're gonna see what it's like over here soon. But this building on University Avenue, we are under contract for this. This is a 9 cap. This is about $50,000 a unit. We brought the buyer to another broker's listing on this. What's interesting here is the facade. They spent like $300,000 on a $100,000 facade job. So the buyer was like, wow, they put on a Ferrari here. Like, this is like really nice. So one of the opportunities in the market that I think the stabilized buyers might be missing, and I don't think it's anyone's fault other than just it's trying to drink from a fire hose right now. If you're a buyer, like, you don't really know where to spend your attention. But this is $50,000 a unit, for eat off the floor, clean, stabilized buildings in a good location. There's nothing wrong with them. The owners just spent 300 grand doing the hard stuff. And yeah, like it just seems like the clean buildings are often lumped together with just every other building. And so if I'm a buyer listening to this right now, I think the takeaway should be really talk to the brokers and get honest feedback of what are the problems, what's the condition, how are the average rents, what could go wrong, and what's been done well, and why is this building different from all of the other opportunities in the market that look the same, sound the same, but are actually very different. This building on Morris Avenue, this is a mixed use building. This is under contract for a 10 cap or a 10.5 cap. So the reason why a lot of the market was not attracted to this is because of the price per unit. I think the price per unit is about like 80 some odd thousand a unit. And the reason is because about 25% of the income is from retail. But this building has 40% upside in the preferential rents in the residential tenants. There's almost no violations, and it's like a real 10 cap. There's $20,000 of arrears in the whole building. And I'm screaming at the top of my lungs, like, why is nobody buying this? I should buy this. It's like a really good deal. We put her under contract for a legit 10 cap. The buyer's going to Chase. He's getting 75% financing, and he's going to close. This was an easy deal. And this is one of the deals that I think the market is missing, because they're like, well, I want buildings at 50 a door, and this is under contract at 80 a door, but this is a 10 cap with no arrears.
Oh, this is basis versus cap rate, right?
Basis versus cap rate. So much comes down to, in these stabilized buildings, like just the address itself. Do I own buildings in the neighborhood? Do I believe that this neighborhood is trending in the right direction or the wrong direction? When I hang out outside the building for 15 minutes, do I feel good? Am I nervous? You know what I mean? Is there a lot of crowd?
Where was the rest of the market on that one? The 10 cap.
This was competitive. We had two other buyers that were, right there, right there. But we went with certainty of execution with a highly qualified purchaser. This building on Fort Washington, this is a perfect example of a total opportunity that the market missed. This is the best location in Washington Heights. Mezuzah's on half the doors. I would go there with my wife and kids, no problem, on a 7 o'clock at night. It's totally safe. A phenomenal neighborhood. This is an elevator building. The hair on the deal, which is, should not be overlooked or understated. There's a few things. Number one, there was union. Number two, there was a high vacancy. Number three, the local law 11 facade needs to be done. There was quotes all over the place, but like anywhere from 500 grand to $1.3 million, that's not financeable. So you got to come out of pocket. So 25% of the value of the building is tied up in an equity check to redo the bricks. So from an IRR and like cash on cash mindset, that's very difficult for people to kind of swallow. There was also a fire in the building on New Year's Eve. That's, that makes you pull your hair out a little bit. So it made it a lot more challenging. We went to contract with somebody who owns a lot in the neighborhood and is just probably going to write a check and close it in a few weeks. But you can go buy, this is under contract for well less than 100,000 a unit. Even after you write the check for, let's say, $1 million, you're in it for 100 a door. You could be in it for a clean building with free market apartments, elevator building in Washington Heights for 100 a door. Like, that's the type of deal that, in my opinion, you kind of got to pay attention to and pay for a little bit. I know it sounds a little counterintuitive to pay up for stabilized buildings, but, not every building is equal. This building on 180th Street, fully stabilized, under contract for 8 and change cap. This was a very competitive process here, right around the corner from the 181st Street retail corridor. We had the buyer of this is a newer-ish buyer to this specific submarket. The equity was coming from Brooklyn. So they own a bunch of buildings in Brooklyn. They're partnering with a manager who owns buildings in Washington Heights. And they're like, their eyes are open. They're like, wow, I could buy buildings in Washington Heights for like 80 a door and 9 caps. So new-ish buyer, quasi-new. This building on Foster Avenue, this is on the market. This I would put in the fantastic opportunity bucket, where you can buy a building in a condo-like condition. I think there's literally one HPD violation. I haven't looked in a week or two, but last time I looked, there was literally one violation on the building. This, if it wasn't a rental, it should be a condo. And maybe that's part of the business plan here, where the condos and co-ops in the neighborhood go for 500 grand and you can buy it for $1 million or excuse me, 100 a door. So if the retail value of the co-ops and condos is 500 grand and you can buy this at 100 grand a door, you can go do a 51% condo co-op conversion. This is just a business idea that people have floated out there. And you can go offer the tenants to buy their own unit for $200,000 a unit. So they're getting it at 50 cents on the dollar. That allows them to go resell it. That's a legit business model, but you can go buy this for, I think, right around a 6.5%, 6.75% cap rate. All right, Mike, taking it back to you. Development.
Seth, a couple of questions from the audience before we kind of transition to development. I think this is a good one for you, Seth. Is a rent freeze likely to happen this year? And any predictions?
Yeah, I mean, 100, yeah, like that. Yeah, of course. The guy's been campaigning on it like night and day for the last 6 months. And I think he's putting it, I think he controls 5 out of the 9 people on the org.
6. He put in 6 of them.
He put in 6. So he put in 6 of the 9 board members. You know, they're supposed to be looking at the data. I'm sure they'll take a peek at it, but let's be real. Like this is a politically charged topic. And if it's not 0%, maybe it'll be 1, 1.5. You know, I go back and forth on this with what's good for the industry in the long run. Obviously, no one on the call is going to be supportive of a rent freeze, but perhaps a little more short-term pain helps with a long-term gain in the conversation of, is HSTPA constitutional? Is it a taking? If you mandate a rent freeze, that probably helps the litigious environment that the folks at NYM, Spony, and the vacancy reset lawsuit are crafting. So I don't know. Does it matter if you get a 1% increase on $1,300 rents or if it's a rent freeze?
Hopefully,
I would assume that you're going to get 0. And if you get anything more than 0, take it as a win.
hopefully it expedites the process as well.
That's what I mean. Expedite the process. Like they're going to, the city council and the far left politicians that are running New York City right now and setting the tone are not going to stop until a lawsuit makes them stop. So maybe a rent freeze helps over the long term. It's not what I would advocate for, but
one more stabilized question, and then we'll move to one more stabilized question, then we'll move over to development, and then we'll answer any other questions. So feel free to put it in the chat, everybody. Given the expense ratios on 100% rent stabilized buildings in your market, Seth, Northern Manhattan and the Bronx, and where debt is priced today, are the buyers actually making a profit? Are they able to be positive leverage? Right. And I'll answer it a little bit because it depends on how much work has to be done. Right. To your point before, local law could cost anywhere from $500,000 to $1.3 million on that building. So I'll turn it over to you, Seth.
It depends on, it's not cap rate. I think the biggest change since post HSTPA and really this like last few years of the inflationary pressure on expenses has highlighted what is the average rent in the building. So historically, you might have said, well, if the rent is below $1,400 and there's no prefs, that's kind of my break even. As the expenses continue to go up, the barometer of what the average rent will be in order to be profitable or at least break even should also go up. So the buildings with the lowest rents, that bucket, the buildings with the lowest rents that are going to be harder to make money on if you don't get a rent increase, that grows as the pressure on expenses grow. So last year you needed $1,400, this year you need $1,500, maybe you need $1,600 rents in 2026 or 2027 in order to have that break-even number. So that's an interesting thing to kind of think about and watch. It's much more of cap on cost versus cap on income. So what has to get done? Does the facade need to get done? Does the boiler need to get done? Are there a bunch of lead violations that need to get remediated immediately before Jake tells you he can't finance the building? You know, what needs to get done in order to bring the building up to like par?
And I'll say the other crucial piece is, look, you can look at an OM surface level. There's positive leverage, but where the rubber really hits the road on these stabilized deals is the collections and arrears.
Yes.
If you don't fit the credit box of the lender, you know, you're in trouble. If you do fit the credit box of the lender, surface level, we're good. But once we peel back the onion, if there are a ton of arrears and collection problems, you know, you're not going to be thrilled with the financing and you're going to be negative leverage.
Yeah. So keep in mind, one of the things that I think people should look at in broker setups, whether it's ours or somebody else's, like what is the vacancy and collection loss that the broker is taking off the top? Because it's just a standardized number, whether it's 3%, 4%, or 5%. Like that's typically what it is. But then when you actually go to finance the building and you look at the arrears report, you might actually need to take 8 or 9% off the top. So when we talk about, oh, what was the cap rate? It's kind of a really nuanced and misleading question to ask, because the answer that you get is not going to be like the same cap rate as if you bought a triple net lease and this is the income, and it's very simple. It's, an 8 cap on the setup might actually be a 7 cap in reality, or maybe the 8 cap is actually pretty accurate. So it really kind of depends. And collections, it's a big issue right now, right, Jake? If you have, how are lenders differentiating between a tenant who maybe is on a payment plan or missed a month or maybe 2 months versus someone who's like consistently late? How do you kind of coach or massage a lender through an arrears report that could look a little scary?
Look, I would say at this point, the lender pool for these assets is really thin. And so, being able to get a loan from a handful of these lenders on any given project, I'd consider a win. The threshold is really, I would say, 60 days, right? If a tenant is more than 60 days overdue, in all likelihood, unless there's some unique story there, the lender is going to discount that rent and not include it in the calculation to come up with the loan amount, therefore reducing your loan amount and your positive leverage.
Yeah, one of the things that we're going to get to, Mike, in a second on development that we've noticed with a lot of the newer buyers in the market that are coming in and trying to find an opportunity, they're asking for financing contingencies. And in New York, historically, it's a hard contract. You shake hands with the seller, and then you do your diligence simultaneous to contract negotiations. And when you sign the contract, it's a non-refundable contract, and your deposit's hard. Now, 9 times out of 10, that's the case, and the buyer ends up being fine and going non-refundable. But a lot of times, if the most qualified purchasers are not at the top of the list, and you want to accept an offer from a newer buyer that's higher than the guy who's super qualified and owns 30 buildings, you should expect that they're going to ask for stuff that the guy who owns 20, 30 buildings will not. And what I mean by that is financing contingencies. So we're out on the market right now. I got a perfect example. We're selling a building in the Bronx. We got an offer literally yesterday. We've been negotiating for a while for $100,000 a unit for a building in the Bronx. Great building, nothing wrong with it. The buyer's in multiple 1031 exchanges from outside New York. He's coming back in. He's asking the seller to remove all the violations. He needs them to do the local law 11 work. And then he's asking for a credit because the seller's like, how do you want me to rep? I can't remove every violation. That's not a realistic expectation. And now he's asking for a financing contingency. Maybe it's not full financing, but maybe it's like, all right, 65% LTV. So these types of conversations are happening. And if you're a seller right now, you should almost expect that and kind of be mentally prepared to work through that. But that's where a lot of the legwork up front from your broker and your mortgage and the purchaser's mortgage broker, if they have one or not, is helpful, where you can kind of pre-qualify the buyer a little bit, get them talking to Jake or talk to the purchaser's mortgage broker to see what their expectations are. What's their liquidity? If they're going for 65% financing, but it turns out they only could get 60, are they out, or are they just kind of trying to get the best deal they can? So it's really, we got to massage it a little bit. But Mike, before we run out of time, I want to hit development. You have been ripping through Brooklyn development. So what's the story with this building? And then we'll get into some high level stuff.
Yeah, so it's Long Island City, Prime Court Square, 50 by 100, hitting almost 400 available, like long-time family office, selling it, taking profit. Again, these areas were selling, low 300s, so, a few years ago. They're up massively, as you can see, 390 per buildable, condo site. So that's what they're going to do there. The next one, we can go to 41st Avenue. Similar thing, again, full asking price on this one right out of the gates, 375 available. Long Island City, Queens Plaza North, another foreign developer. Again, full ask very quickly. So again, demand's there, condo site again. And again, both these sites were perfect 50 by 100 rectangles that so that's key in development. These, symmetrical sites are hitting premiums, right? That's part of it.
Oh, that's interesting. When somebody buys one of these development sites, are they typically putting in a shovel right away, or are you kind of seeing them hang out and waiting for an even better market to do it? How do you think about that?
I think typically, but we're able to get developers pay premiums for longer closes. The Queen sites we just sold, those were shorter closes, but typically like developers, they'll want a 3 to 6 month close, but they'll pay an extra, call it 5 to 10% on top because they can mitigate carry costs. So, but they're trying to get, a lot of times they're trying to get approved plans before the closing, and a lot of times that helps because the sellers are in exchanges. So it ends up being a win-win. So.
Have you ever had a scenario where a developer is under contract and trying to get their approved plans, but then maybe get denied with the plans and come back and say, "Oh, I hit a speed bump"?
All the site was always not non-contingent, no environmental contingencies. So like we haven't run into that. Could it happen? Sure, but typically with these sites, at a certain eve execution, they know what they can build, and also, we're not going to recommend a seller going into a contract with a developer that's a novice, right? Unless it's some insane price and the terms are really good. Yeah. So these guys know what they're doing, and that's the part of development that's different than a lot of these tenanted buildings. Is you have the certainty of execution like you do in the vacant buildings. So
interesting. And what would you say are most developers doing condos? Is there any business plan for rental or affordable housing, or is this pretty much?
I would say in this business, we live by the Charlie Munger quote: "Show me the incentive, I'll show you the outcome." And I think the incentives are only aligned with condo pricing right now because the 45X is, average at best in terms of an abatement. So everybody's for the most part building condo, unless there's a unique use like this for 45 grand that's on the market or that we're in contract. Like we're selling this to a big Belgian fund that's going to do a co-living concept, and they have a very unique business plan. They're very good at it, and they execute it quickly. But again, that's the very well located vacant brick statutorily free market building, was exempt from certificate of non-harassment, which again is another layer of kind of regulation that you have to deal with when you're buying these existing buildings. But yeah, it's the vacant buildings with air rights are selling, just as much as the sites right now. So
interesting. Jake, I want to get you chiming in here on like development financing, and then we'll go through some of these closings that you had here. Well, how is the market for financing development sites right now, development projects? How would you kind of compare that to, let's say, just like a little free market building? Is it just as robust in terms of lender pool, or is it like a little tighter? How do you think about that?
Yeah, great question. So certainly as robust, if not more, on the permanent side. If you look at the 10-year treasury year over year, the 10-year treasury a year ago closed at 438. Today we're at 428 or vice versa. So, pretty much the same. But on the construction financing side, we've seen spreads come in, about 100 basis points or so. So I'll give you an example. We were out to market 12 months ago on a deal in Miami, institutional client building a 35-story tower, and the offers were coming in at 350 over SOFR. We signed a term sheet on that deal a month ago or so at 240 over SOFR, and we actually had offers that were lower as well. But, for one reason or two, we went with the lender at 240. So it's incredibly frothy. I think it speaks to, in New York specifically, lenders want to lend on assets that don't have regulatory risk per se. And I think we're going to continue to see upward pressure put on free market rents.
Yeah, well said. All right, why don't you walk us through some of these closings that you've done a bunch of stuff, in New York and outside New York. What's this deal? This looks like a nice building. No one's in the parking lot in this building, but pool looks nice. What's the story with this?
Yeah, this was a good one. Look, we've seen a lot of people exit New York. We've seen people come back. We've seen people continue to buy in New York and other places around the country. But this was, I think, 2011 vintage, This is a bridge loan plus CapEx funding. So we closed this a month or two ago, and the deal was done at 70% of cost and SOFR 265. So with a buy down. So I think the all-in rate ended up being 595 or something like that. Is somewhat on par with permanent financing, not agency.
Nice. Good for you. Congratulations. All right, dear Washington Heights closed $12.5 million. What was the term on this? How did this deal come together?
Yeah, this was a long-term owner. The individual owns a lot of buildings and has started selling them off. One of our mutual clients, Seth, felt like this was a great opportunity to add to the portfolio. And so we did this deal at 75% loan to value. I think the rate was somewhere in the neighborhood of 5.5%.
Yeah.
Starting term, we've seen more investors decide to go with shorter term paper, so 3 or 5 year paper, mainly because of the belief that rates will come down in the future, the next couple of years or so. I think everyone was anticipating, at least a couple of cuts this year, but because of the turmoil in the Middle East, that doesn't look so probable now. And so we likely don't see any cuts at this point. But yeah, look, this was a great win for, anyone who owns a rent stabilized asset. We got this deal done at 75 LTV, 5.5 rate.
The 3-year term, I think, is interesting to me because this is two deals in a row that you did 3-year terms. If you were to quote this deal today, a fully stabilized apartment building acquisition, what would you tell me? Just like you have 10 seconds to answer the question, assuming 94% collections. What's my rate, LTV?
Yeah. Yeah. Look, so I'd be lying if I said it wasn't going to hinge on the sponsor. That with rent stabilized assets, that is the most important determining factor of where we will land on a loan and if we will land at all. But as far as rate goes, we're not too far above 550. We're probably closer to 575 today, given the treasury's up because of the turmoil in the Middle East. But, we're going to be in that 70 to 75 range, assuming the sponsor is qualified.
Yeah. One last thing before we go, we're doing a deal with Freddie, and I forget who the sponsor is, or is with Freddie, but the litany of questions they ask, it's unbelievable. The agency financing, the amount of questions and requirements and do this, do that, right? Reporting. It is, if you don't have a seller that has a full management team to deal with document requests and like fixing the building and stuff, it's very difficult. So was this a local savings bank that did this? And what was were there any hurdles that were maybe challenging to overcome, or was this kind of like the path of least resistance?
This was the path of least resistance. And what I'll say is the agency process can be a nightmare, depending upon the scenario. If all things are equal and you're buying that deal on 1 Arden Street in New York City, I would recommend you go with that local bank.
Yeah, got it. And then I want to give you your flowers here on some of these bigger ones. Congratulations on this. Who's buying, not specifically, but this looks like a nice waterfront property an hour north of the city. What's the story there real quick?
Yeah,
We're gonna wrap up.
This is the best multifamily deal I've seen in my entire career. This is a family office that's been investing in New York City for 70 years and was able to procure this deal off market because of a very close relationship to the seller. So that was a great deal. The other deal you referenced, the New Jersey deal, was a mix of assets, both retail and industrial, for a good client who owns a number of assets throughout the state. And we got that deal done right around 6%, which was a big win for the client at the time.
All right, guys. Well, we're right at the hour mark here, so I think it's probably a good time to wrap up. For those of you guys who see the screen right now, please feel free to check out our podcast available on Apple, Spotify, and YouTube. The articles on the website that we kind of put out once a month or so, just to kind of everything that pops into my head kind of ends up on the keyboard. But yeah, thank you all for joining. We really appreciate it. Panelists, Jake, Mike, Joe, and Andrew, thank you for spending an hour with us and sharing your wisdom. If anyone has any questions or comments or anything, please feel free to reach out to any of us at any time. And we look forward to seeing you guys again soon.
Thank you, everyone, for joining.